In this module, we shall discuss the monetary policy in action with special reference to India. The monetary policy of any country refers to the regulatory policy whereby the monetary authority maintains its control over the supply of money for the realization of general economic objectives. Monetary policy can be broadly defined as a deliberate effort by the central bank to influence economic activity by variations in the money supply, in availability of credit or in the interest rate consistent with the specific national objective. In a broader sense, monetary policy not only includes monetary measures but also non-monetary measures which have monetary effects. In this sense, monetary policy covers a wide range of policies and measures. It includes not only monetary measures which influence the cost and availability of money, but also those non-monetary measures which influence monetary situations. But to be more specific on the actions, that is, its instruments to achieve certain targets, it can be stated that monetary policy comprises only those decisions and measures of the state and of the monetary authority which affect the volume of money and the level of interest rates. Thus, monetary policy is defined as comprising of such measures which lead to influencing the cost, volume and availability of money and credit so as to achieve certain set objectives. Johnson 1963 defines monetary policy as policy employing central bank's control of the supply of money as an instrument for achieving the objectives of general economic policy. Shah 1960 also says that monetary policy refers to any conscious action undertaken by the monetary authorities to change the quantity, availability or cost of money. In the Indian context, the Reserve Bank of India is relatively more explicit in defining the monetary policy. For it, monetary policy operates through influencing the cost, volume and availability of credit and money. It seeks to influence aggregate demand indirectly through influencing the credit position of commercial banks. So, according to RBI, the monetary policy in India refers to the use of instruments within the control of central bank to influence the level of aggregate demand for goods and services. Central banking instruments of control operate through varying the cost and availability of credit, those producing desired changes in the asset pattern of credit institutions, primarily the commercial banks. Hence, we can say that while we discuss the monetary policy of any country in its action, it is important to know about its targets, instruments used for achieving those targets, the achievements and the failures. Hence, this module is an attempt to discuss all these aspects in case of monetary policy in India. Let us first discuss about the targets of any monetary policy. After studying this module, you shall be able to discuss about the targets of monetary policy in any economy, analyze the monetary policy in action, understand the evolution of monetary policy in India, know about the changes in instruments of monetary policy in India. First, we shall discuss the targets of monetary policy. Generally, a monetary authority follows three targets. These are maximal employment, price stability and interest rate stability. The achievement of these objectives also runs in consonance of the objectives of economic growth and balance of payments equilibrium. First is the employment objective. Achieving full employment of resources is considered to be the most important objective, as the underemployment and unemployment implies wastage of scarce resources which no economy can afford to have for a long period. Admitting that the full employment, defined as complete absence of the involuntary unemployment, is hard to achieve, as there is always some frictional unemployment in the economy. Therefore, the monetary authority aims to maximize the employment rate through expansionary monetary policy. During recessions, it is important to raise the level of investments through reductions in interest rates. Next is the price stability. One of the policy objectives of monetary authority is to stabilize the price level. Rising and falling prices are both bad because they bring unnecessary loss to some and undue advantage to others. Again, they are associated with business cycles. So, a policy of price stability is deemed to be necessary to maintain certain levels of growth as well as welfare. Price stability does not mean that prices remain unchanged indefinitely. Stable prices reduce the incentive to invest. Price stability can be maintained by following a counter-cyclical monetary policy, that is easy monetary policy during a recession and a dear monetary policy during a boom. Next is interest rate stability. Interest rates represent the cost of investment, which is the increase in capital stock of the economy and an essential requirement for the growth of the economy's output capacity. Hence, it can be argued that low rates of interest imply higher investment and therefore higher growth rates for the economy. Many countries, especially the LDCs, in the second half of the 20th century followed this reasoning to set interest rates in the organized markets of their economies below what would have been determined in unregulated markets. Interest is not only the cost of funds borrowed for investment, it is also the return on savings lent through the financial markets. Although the classicals and the neoclassicals hypothesize a positive relationship between the rate of interest and savings, the empirical significance of this dependence of savings on interest rates is of considerable doubt. There are more evidences which show the relationship of savings with income rather than the rate of interest. Thus, if savings are not much influenced by interest rates while investment does so, it could be argued that keeping the rates of interest low would promote growth of the economy on a net basis. Interest rates, however, also play the role of allocating funds between the various projects and sectors of the economy, and the stability of the rate of interest in much desirable to retain the capital in productive sectors than to be used for speculative and unproductive activities. The last is economic growth. Rapid economic growth is the undisputable objective among the policymakers. It is a process which shows an increase in real per capita income over a long period of time. With increasing volume of production, it also means raising the standard of living of the people and reducing inequalities of income distribution. The monetary authority may influence growth by controlling the real interest rate through its effect on level of investment. By following an easy credit policy and lowering interest rates, the level of investment can be raised, which promotes economic growth. Monetary policy may also contribute towards growth by helping to maintain stability of income and prices. So, monetary policy should be such that encourages investment and at the same time controls hyperinflation so as to promote growth and control economic fluctuations. Moving on to the monetary policy in action. It is important to know how a monetary policy works to achieve its targets. The monetary authority in any country generally has three main instruments. These are the discount rate, the reserve requirements and the open market operations. The discount rate. Discount rate is the interest rate the central bank charges commercial banks for short-term loans. Lowering the discount rate is expansionary because the discount rate influences other interest rates. Lower rates encourage lending and spending by consumers and businesses. Likewise, raising the discount rate is contractionary because the discount rate influences other interest rates. Higher rates discourage lending and spending by consumers and businesses. Reserve requirements. Reserve requirements are the portions of deposits that banks must hold in cash either in their vaults or on the deposits at a reserve bank. A decrease in reserve requirements is expansionary because it increases the funds available in the banking system to lend to the consumers and businesses. An increase in reserve requirements is contractionary because it reduces the funds available in the banking system to lend to the consumers and businesses. Open market operations. By far, the most frequently used tool is open market operations, the buying and selling of government securities. Open market operations imply the purchase and sale of securities by central bank in the open market. One such security is treasury bills. When the central bank sells securities, it reduces the supply of reserves. When it buys back securities by redeeming them, it increases the supply of reserves to deposit money banks, thus affecting the supply of money. The open market operation policy is that policy by which the central bank contracts or expands the credit by sale or purchase of securities in the open market. Hence, it attempts to increase or decrease the credit in the system by directly influencing the cash reserves with the banking system. In recent times, open market operations are being used increasingly as an instrument of credit control. During inflation, the central bank sells securities in the market. The individual buyers make payments by withdrawing their deposits with banks. If the buyers are commercial banks, their cash holding with the central bank gets reduced. So, the banks are forced to stop, grant fresh loans and recall loans already granted. The investment activity in the economy gets slackened and the inflationary situation is reduced. During depression or crisis, the central bank purchases securities from the open market, in which banks are also included. The RBI pays cash in return to the seller of the securities. For public deposits, their money with the banks. This increases the cash balances of commercial banks, which are used to give fresh loans. There will be a rise in the level of economic activity and consequent increase in the level of investment, employment and price. Further, we discuss the monetary policy in India. We have discussed that there are certain objectives of the monetary policy that are to be achieved through certain instruments. This requires articulation of a consistent monetary policy framework that enables transmission of policy signals in such a way that monetary and financial conditions are influenced to the desired extent to attain the objectives. Monetary policy framework in India is continuously evolving process contingent upon the level of development of financial markets and institutions and the degree of global integration. Monetary policy framework in India has evolved over time. Its focus has shifted from a controlled expansion in the initial years to an anti-inflationary policy in the recent years. Recent global financial crisis has also questioned the virtue of the entire focus of monetary policy on price stability that has failed to ensure financial stability. In India, the developments in the government securities, markets and money market brought about by financial sector reforms have led to several changes in the operating procedure of monetary policy of India. During this process, the liquidity management facility, that is LAF, has emerged as the main operating procedure of monetary policy, with repo rates as the key indicators for signaling the monetary policy stance. Besides, other instruments such as open market operations, cash reserve ratio and statutory liquidity ratio are equally important and work in coordination with each other for common objectives. An evolution of monetary policy operations in India. The monetary policy in India has undergone several shifts ever since the inception of Reserve Bank of India. In its formative years during 1935 to 1950, the focus of monetary policy was to regulate the supply of and the demand for credit in the economy. It relied more or less upon the bank rate, reserve requirements and open market operations for this purpose. However, after independence, after planned development started in India till 1970, the monetary policy introduced several quantitative control measures to contain the consequent inflationary pressure while ensuring credit to preferred sectors. These measures included selective credit control, credit authorization scheme and social control measures to enhance the flow of credit to priority sectors. The bank rate was raised very often during this period. The period 1971 to 90 saw the focus of monetary policy on credit planning. However, these periods mainly saw the dominance of fiscal policy over monetary policy. To raise resources for the government from banks, the statutory liquidity ratio or SLR was progressively increased and was as high as 38.5% by 1990. Similarly, the cash reserve ratio or CRR was gradually raised from its statutory minimum of 3% to 15% during the same period. Then, in 1985, the monetary targeting framework based on the recommendations of Chakravarti Committee 1985 was adopted. Under this framework, reserve money was used as operating target and broad money or M3 as an intermediate target. Then in 1987, Waghol Committee recommended the use of a variety of money market instruments such as interbank participation certificates, certificates of deposits or CDs, and commercial papers, that is CPs, etc. Then during the 90s, the structural reforms and financial liberalization led to a shift in determination of interest rates and exchange rate. The CRR and SLR were brought down to 9.5% and 25% by 1997. Then in 1998, following the recommendations of Narasimhan Committee 2, the RBI introduced the Interim Liquidity Adjustment Facility or ILAF in April 1999, under which liquidity injection was done at the bank rate and liquidity absorption was through fixed reverse repo rate. Then full-fledged liquidity adjustment facility LAF was operated through overnight fixed rate repo and reverse repo from November 2004. The LAF helped to develop interest rate as an instrument of monetary transmission. The operating policy rate alternated between repo and reverse repo rates depending upon the prevailing liquidity conditions. Thus, the new operating procedure retained the essential features of the LAF framework with the following key modifications. The first one is the weighted average overnight call money rate was explicitly recognized as the operating target of monetary policy. Second, the repo rate was made the only one independently varying policy rate. Third, a new marginal standing facility or MSF were instituted under which the scheduled commercial banks or SCBs could borrow overnight at their discretion up to 1% of their respective net demand and time liabilities, that is NDTL, at 100 basis points above the repo rate. Fourth, the revised corridor was defined with a fixed width of 200 basis points. The repo rate was placed in the middle of the corridor, with the reverse repo rate 100 basis points below it and the MSF rate 100 basis points above it. Thus, the new operating procedures of the monetary policy in India have improved the liquidity adjustment facility to move towards the international best practices. This has tried to remove the confusion regarding the policy stance by suggesting a single policy rate. The institution of MSF has also provided a safety valve against unanticipated liquidity shocks through a fixed rate corridor, which will help keep the overnight average call money rate close to the repo rate. However, as pointed out by Mohanty in 2011, the monetary system in India is currently facing three main challenges. These are: number one, there is a great challenge to keep the systematic liquidity in a deficit mode consistently so that accurate forecasts for the liquidity could have been made. However, there are many factors which may inhibit these forecasts. These are uncertainty regarding government cash balances and unanticipated swings in capital flows, etc. Hence, there is a need to put in place a system which can reasonably forecast the changes in these autonomous determinants of liquidity. Number two, conducting long-term liquidity management operations through instruments like open market operations, market stabilization scheme and CRR is a real challenge, as the success of these instruments is largely restricted by the market signals. This becomes especially more challenging when there is a persistent surplus of government cash balances, resulting in sustained capital inflows or liquidity drains. Number three, The success of monetary policy lies in the achievement of ultimate objective of sustained growth with price and financial stability. This entails improved transmission of short-term interest rates to long-term commercial interest rates. This will require further deepening of financial markets and removal of structural rigidities coming in the way of market determination of interest rates. Now let us discuss the changes in instruments of monetary policy in India. Here we can briefly discuss how the monetary policy in India has changed its reserve requirements and other instruments over a period of time to achieve its targets. However, in consonance with international experiences and the financial sector reforms initiated in the early 90s, the monetary policy framework in India witnessed a transformation from direct to indirect instruments of monetary control. Whereas the direct instruments include the cash and liquidity reserves, the indirect instruments include bank rate, marginal standing facility, market stabilization scheme and open market operations. Changes in reserve requirements. Among the direct instruments for CRR, the RBI was earlier empowered to impose and alter it anywhere between 3% to 15% of net demand and time liabilities. But now, as per the RBI Amendment Act 2006, it has been given the flexibility to fix the CRR without any ceiling rate. Pursuing its medium-term objective of reducing the CRR, the RBI has reduced the CRR progressively in phases from peak of 15% in 1992 to around 5% in the recent years. Currently, the CRR stands at 4%. SLR, another instrument of monetary policy control, was first imposed on banks in 1949 and was fixed at 20%. It remained at this level for almost 15 years till September 1964 when it was raised to 25%. In the post-1990 era, phased reduction of SLR was designed and efforts were made to make banks and financial institutions hold government securities voluntarily. The SLR was 21.5% of net demand and time liabilities, that is NDTL, as of June 2015. The bank rate was fixed at 3.5% in 1935 and after a few sporadic changes, it was increased to 12% in 1991. Actually, as a monetary instrument, the bank rate remained almost dysfunctional up to 1997 but was sharply used between 1998 to 2003 with the rate varying from 11% in April 1997 to 6% in April 2003. But after the introduction of LAF, it again started losing its significance to the modulations in the reverse repo rate and the repo rate. However, in February 2012, as part of money market operations, the RBI aligned the bank rate with marginal standing facility rate, which in turn is linked to the policy repo rate under the LAF. During 2013-14, the bank rate stood at 8.75%. The LAF was introduced in June 2000. It consists of daily infusion or absorption of liquidity on a repurchase basis. Through repo, that is liquidity injection, and reverse repo, that is liquidity absorption, auction options using government securities as collateral. The LAF is operated through overnight fixed rate repo and reverse repo, which further provided the informal corridor for the call money rate. However, there are two major drawbacks. One is the lack of a single policy rate and second was the lack of a formal corridor. To overcome these shortcomings, a new operating procedure for LAF was put in place in May 2011. Marginal standing facility. Before the new operating procedure of LAF was introduced, the repo rate and the reverse repo rate were informally supposed to be the boundaries of the LAF corridor so as to enable the call rate to settle in between. However, these limits were generally crossed due to excessive surplus or shortage of liquidity in the market. Therefore, the MSF was introduced in May 2011 to serve as an upper bound of the corridor and was fixed as 100 base points above the repo rate. It is a kind of safety valve. During 2013-14, the MSF rate stood at 8.75%. Open market operations. Recently, the open market operations have gained a significant place as an effective monetary instrument. Since 2008-9, on account of liquidity deficit, there has been an ongoing increase in the open market purchases by RBI. During 2013-14, the net value of open market operations was rupees 16,675 crore. Market Stabilization Scheme or MSS. Post 1990 reforms, India witnessed a significant increase in capital flows which posed serious challenges to the conduct of monetary policy. Therefore, to absorb the liquidity of an enduring nature, MSS was introduced in April 2004. Under the MSS scheme, the Reserve Bank issues treasury bills dated government securities by way of auctions on behalf of the government, and the money raised is impounded in a separate cash account maintained and operated by the RBI. The amounts credited into the MSS account are appropriated only for the purpose of redemption and or buyback of T-bills and or dated securities issued under the MSS. Cash management bills or CMBs. The RBI has used CMBs introduced in May 2010 as a tool to manage liquidity in the system by auctioning CMBs to drain out excess liquidity from the banking system and check volatility in the foreign exchange market. Let us now summarize what we have learnt in this module. Over the years, the monetary policy in India has evolved with diverse tools being introduced to achieve the desired results such as price stability, boosting economic growth and maintaining financial stability. Besides other traditional instruments, the LAF framework of RBI has progressed as a flexible monetary policy tool that has not only helped in stabilizing the money market rates but also helped strike a comfortable liquidity position among market participants. The introduction of MSF rate has also provided freedom to the central bank to maneuver liquidity management in Indian money markets.